There are several important aspects that a beginner needs to take into account before entering trade on the foreign exchange. At the moment, there are many platforms from which you can make your first trade. A good tip here is that you don't necessarily have to rush into the actual trade with a broker. You can first try to get a practice account, which doesn't expire and is there until you are ready to go live. One of the accounts like this is offered, for example, by Oanda, but in fact, there are many more for you to choose from. And now, let's move to the actual steps of trade. First of all, you obviously need to select a currency pair, as the whole nature of Forex marketplace is to exchange the value of one currency to another. Let's imagine the pair you are interested in is Euro to USD. Next, the research and analysis take place. It is always a better strategy to back up your operations in the market by the actual analysis you've made. In other words, your decisions have to be rational. Things on which you should focus your attention are current and historical charts of the currency value, global economic news, monitor interest rates and political situation. The third step is that you actually understand the quote. As you can see, in our example, Euro is a base currency and USD is a so-called quoted currency. Now we are going to look at the situation from the perspective of the market taker, as market maker is bank or a broker, while market taker is a customer. Therefore, for a market taker, a bid price indicates how much of base currency do you need to sell in order to buy the quoted one. Meanwhile, the offer price is a price that shows how much quoted currency do you need to sell in order to buy the base one. The difference between the bid price and the offer price is called the spread. Next, you have to pick your position of either bull, buying, or bear, selling. It is important to know that Forex is slightly different from stock market and bonds, where you can only perform in one direction of the market, which usually is up. Forex trading, in its turn, represents a two-way transaction, meaning you actually buy one currency while selling another at the same time, which gives you more opportunities to speculate on both up and down movements in the markets. And now let's look at the positions. The first one is bull or buy position. It acquires when you believe the value of the base currency will rise compared to the quote currency. So then, in our example, you believe that euro will strengthen against dollar. In other words, euro is bullish. The next position is the bear position or selling position. You are in this position if you believe that the value of the base currency will fall compared to the quote currency. Thus, in our example, it means that euro will weaken against dollar. Consequently, euro is bearish. And now I'm going to illustrate the both positions on practice. And let's imagine that this is the current exchange rate of euro to USD. Imagine we are going to be in the buy position. So we are going to buy the currency for the price of 1.33840. And now again, imagine that later that day, you see that the exchange of euro to USD has changed and now equals 1.34160 to 180. So if you actually compare the price for which you bought, which is 1.33840, and the current course, which is 1.34160, you can see the difference of 32. This is called a 32 pips gain. We have never mentioned the amount of currency we are buying, but let's imagine we are talking about 100,000. And then, in this situation, you would actually make a profit of $320. Now let's imagine a completely different situation. A situation in which we have entered a sell position. So that means that you believe that euro will depreciate, meaning lose its value. So you want to sell it while it's still relatively high. The price for which you're going to sell according to our example, would be 1.33820. However, as we already imagined, later that day, the exchange rate from Euro to USD will change, but it will become higher, meaning Euro actually depreciated instead of depreciating. Obviously, you're going to encounter a loss, but a loss how big? Well, to answer that question, we have to compare the price for which you actually sold, which is 1.33820, and the price for which you could have sold now, which is 1.34180. It gives us a difference of 36, meaning you encountered a 36 pips loss. Transferring it from the pips to the actual money value, we receive a loss of 360 US dollars. On that note, I would like to thank you for watching the video, and I truly hope that from now the basic steps of trade have become a tiny little bit more understandable for you. Bye!